Most retirees are paying more for Medicare than they should be, and they have no idea why. The IRS is using a 2-year-old tax return to determine how much you owe for health insurance right now. And if your income spiked in that 2-year window for any reason, you are paying a surcharge that nobody told you was coming and that most people do not even know exists. That surcharge has a name. It is called IRMAA, the Income-Related Monthly Adjustment Amount. And by the time most retirees learn what it is, they are already paying it. I am going to explain exactly how the IRMAA formula works, which income events trigger it, why the 2-year look-back catches people who thought their income was completely under control, and what can still be done to avoid or reduce it. Medicare Part B covers doctor visits and outpatient services. Medicare Part D covers prescription drugs. Both programs charge monthly premiums. In 2024, the standard Part B premium is $174.70 per month. For a married couple both enrolled in Medicare, that is $349.40 per month between them in standard premiums. But IRMAA adds surcharges on top of those standard premiums for people whose income exceeds certain thresholds. There are 5 IRMAA tiers. Each tier adds a larger surcharge. At the highest tier in 2024, a single filer pays $594 per month for Part B alone. That is $419 per month above the standard premium. For a married couple, both at the highest tier, the combined Part B premium is $1,188 per month. That is $14,256 per year just for Part B. The standard couple pays $4,193. The difference is over $10,000 annually for the same coverage, and they did not choose that tier. The IRS assigned it to them based on income from 2 years ago. Here is how the mechanism works. Medicare premiums for any given year are based on your modified adjusted gross income from 2 years prior. Your 2024 Medicare premium is based on your 2022 tax return. Your 2025 premium is based on your 2023 return. The Social Security Administration receives income data from the IRS on a 2-year delay and uses that data to set the premium tier for the following Medicare year. The 2-year look-back creates a specific trap for retirees. Most retirement planning focuses on managing income going forward, but the income that determines your Medicare premium is already locked in. It was finalized when you filed your taxes for the year in question. By the time you enroll in Medicare and discover the surcharge, the income that triggered it is 2 years old. You cannot go back and change it. What kind of income events trigger IRMAA? The most common is the year a person retires. Many people retire mid-year. In the first half of the year, they are still earning salary. In the second half, they may take retirement account distributions, receive severance, exercise stock options, or sell investments. That retirement year income is often the highest combined income of their career because it blends salary with retirement distributions. 2 years later, when Medicare starts, the Social Security Administration looks at that spike year and places the new enrollee in a high IRMAA tier immediately. The second common trigger is Roth conversions. Roth conversions are taxable in the year they occur. A person who converts $150,000 from a traditional IRA to a Roth in a single year adds $150,000 to their modified adjusted gross income for that year. 2 years later, that conversion year becomes the benchmark for their Medicare premium. A well-intentioned tax strategy that was supposed to reduce future taxes can simultaneously increase Medicare premiums by several $1,000s per year for up to 2 years. The third trigger is selling real estate. If a parent sells a vacation property, a rental property, or a primary residence that has appreciated significantly, the capital gain from that sale shows up in modified adjusted gross income for the year of the sale. A vacation home purchased for $80,000 decades ago and sold for $400,000 generates a gain that can push a retiree into the highest IRMAA tier, even though they have no intention of having that income again. The Medicare formula does not know the sale was a one-time event. It sees the income and sets the premium accordingly. The fourth trigger is required minimum distributions in combination with other income. A retiree drawing Social Security, taking required minimum distributions from a large 401k, and receiving pension income can exceed the IRMAA thresholds without any unusual income event at all. The accumulation of ordinary retirement income sources is enough to push them above the first tier, which begins at $103,000 for a single filer in 2024. Let me give you the specific IRMAA tiers for 2024 so you can see exactly where the thresholds fall. For a single filer, modified adjusted gross income below $103,000 means standard Part B premium only. Between $103,000 and $129,000, the monthly Part B premium jumps to $244.60. That is a $69.90 monthly surcharge above the standard rate. For the full year, that is $839 in additional Medicare cost. Between $129,000 and $161,000, the monthly premium reaches $349. Between $161,000 and $193,000, it reaches $454. Between $193,000 and $500,000, it reaches $549. Above $500,000 for a single filer, it reaches $594 per month. For married filing jointly, the thresholds are doubled. The surcharges apply separately to each enrolled Medicare beneficiary. A couple where both spouses are on Medicare and both exceed the first threshold pays double the surcharge shown above. The Part D IRMAA adds additional surcharges on top of prescription drug plan premiums. At the highest income tier, the Part D IRMAA surcharge alone is $81 per month per enrollee, on top of whatever the plan itself charges. Now I need to explain the widower trap inside IRMAA because it is the cruelest version of this problem. When a spouse dies, the surviving partner files as a single person the following year. The single filer IRMAA thresholds are half of the married filing jointly thresholds. The exact same income that stayed below the first IRMAA tier for a married couple now falls inside the surcharge zone for the surviving single filer. Their Medicare premium goes up the year after their spouse dies, the same income, higher premium, because the tax filing status changed. A couple with combined income of $180,000 files jointly. They are below the married filing jointly. First IRMAA threshold of $206,000. Standard premiums. One spouse passes away. The surviving spouse now has income that may still be around $90,000 to $100,000 annually. On a single filer basis, that income crosses the single filer first IRMAA threshold of $103,000 if the survivor has any other income added in, such as required minimum distributions or a small pension. The premium increases at the moment of greatest financial vulnerability. This is structurally identical to the widow tax trap that applies to Social Security taxation. The same underlying mechanism in the tax code that taxes more of Social Security income after the death of a spouse also pushes more surviving spouses into IRMAA surcharge territory. Let me address the life change appeals process because this is the one mechanism that can actually fix an IRMAA problem after the fact. If your income in the look-back year was unusually high due to a life-changing event that will not recur, you can appeal the IRMAA determination. The Social Security Administration accepts appeals based on specific qualifying life-changing events including marriage, divorce, death of a spouse, loss of income, producing property, loss of pension, reduction in work hours, or full retirement. The key word is qualifying. A one-time capital gain from selling a vacation home does not automatically qualify for a life change appeal, even though the income will not recur. A Roth conversion does not qualify because it was a voluntary financial decision rather than a life-changing event. The events that qualify are generally circumstances outside the person's control. For events that do qualify, the appeal allows the Social Security Administration to use a more recent year's income instead of the 2-year-old return. If a person retired in the middle of the previous year and their income will be substantially lower going forward, they can appeal using estimated current year income or the most recent lower income year to get placed in the correct IRMAA tier immediately. This appeal process exists but requires documentation, an application, and a processing period. People who do not know about it simply pay the higher premium for the full year before any adjustment is made. So what can families do before the IRMAA surcharge hits? The first strategy is income smoothing before Medicare eligibility. IRMAA applies starting at age 65 when Medicare begins. The income that determines your first Medicare premium is from 2 years prior, meaning your 63-year-old income. For people who retire at 62 or 63 and are planning Roth conversions during the gap years before Medicare, the conversion size in those years directly determines the first Medicare premium tier. Conversions that keep modified adjusted gross income below the IRMAA threshold preserve the standard premium while still accomplishing the Roth conversion goal. Larger conversions that cross a tier may cost several $1,000s in higher Medicare premiums for 1 to 2 years. The math sometimes still favors the conversion, but it should be calculated explicitly. The second strategy is capital gain timing. If you know you are going to sell appreciated property, timing the sale to a year when your other income is lower can reduce or eliminate the IRMAA impact. A person who sells a rental property in the same year as a required minimum distribution and Social Security income may push into the highest IRMAA tiers. The same sale in a year with lower other income may stay below the first tier entirely. This requires advanced planning because the tax return is filed after the year is already over, but the income decisions can be made throughout the year. The third strategy is qualified charitable distributions. If you are over 70 and a half and charitably inclined, qualified charitable distributions allow you to satisfy required minimum distribution requirements while excluding the distribution from your modified adjusted gross income. Distributions sent directly from an IRA to a qualifying charity do not count toward IRMAA income. A retiree who would otherwise exceed the first IRMAA threshold by $30,000 can direct $30,000 in IRA withdrawals to charity, satisfy the distribution requirement, and stay below the threshold. The charitable deduction works differently because it was never included in income to begin with. The fourth strategy is the IRMAA appeal for qualified life events. If you had a one-time income spike 2 years ago due to a qualifying event and your income has since dropped substantially, file the appeal immediately at your local Social Security office. Do not wait for the annual recalculation. The recalculation happens automatically as new tax data is received. The appeal uses current year income and can take effect much faster. Here is the truth that most people entering Medicare do not know. The surcharge is automatic. You do not choose to be in an IRMAA tier. The IRS sends your income data to the Social Security Administration, the formula runs, and a letter arrives telling you your premium. If you do not understand what drove the result, if you did not know the 2-year lookback existed, if you had no idea that a Roth conversion or a home sale from 2 years ago was about to affect your health insurance cost, you simply pay the higher premium and wonder why Medicare costs more than you planned. The people who avoid or minimize IRMAA are the ones who plan their income specifically around the thresholds in the 2 years before Medicare enrollment. They kept modified adjusted gross income below the first tier, or they deliberately crossed a tier for a Roth conversion and built the premium cost into the calculation, or they filed a life change appeal that corrected a look-back year that no longer reflected their actual financial situation. The formula is not hidden. The thresholds are published annually by the Centers for Medicare and Medicaid Services. But most financial advisors who are not specifically focused on retirement income planning do not build IRMAA modeling into the conversation at 63 or 64 years old, which is exactly when the decisions that determine the first Medicare premium are being made. If you are between 60 and 65, find a fee-only advisor who specifically models IRMAA in their retirement income planning. Ask them to show you your projected modified adjusted gross income for the 2 years leading into Medicare eligibility and show you which IRMAA tier each scenario places you in. That conversation at 63 is worth thousands of dollars. The same conversation at 66 is too late to change the first 2 years of premiums. The formula runs. The letter arrives. Most people have no idea it was coming.